This is a really good question by Matt, the business coach. If you want to know how the directors get paid, or you're a director yourself, this video is for you. Firstly, directors can get paid in several ways. The several ways directors can be paid is number one, salaries and wages. Number two, contracting fees, being a genuine contractor. Number three, they can be paid in the form of shares that they are given in the organization. Directors might be given a different class of share to the ordinary shareholders, and then dividends would be paid to their shares. They might also be allotted further shares if they meet certain performance targets. Now, here we're talking about larger companies. For sole directors, the considerations would be number one, do I pay myself salaries and wages, income, including superannuation? Number two, do I pay myself a dividend? Or number three, do I pay myself as a contractor? They might decide to do a mix of these depending on the activities that they provide to the organization. So you need to look at the particular situation of the client and find out exactly what suits them best, depending on the rules that they meet. For our advisory clients, when we come to do year-end business and tax planning, we look at their superannuation balances, we look at the franking credits that are available, we look at the dividends, we look at the profits, we look at whether they're going to get paid dividends or if they're distributions, if they're using something like a unit trust or a family trust. We take all these things into consideration. We ask them what they want to do on a commercial basis, and then we also look at tax minimization. But commerciality of transactions are always the most important. There's certainly legal implications, but there's also financial implications. An example is if a payment method stifles the company from much needed liquid cash to help it grow, then it's probably best not to consider that particular way of payment.